Hi, everyone, and welcome to today's webinar hosted by McClintock and Associates. My name is Mike Weary, and I will be your moderator. Today's webinar will be focused on the audit standard related to leases, which is ASU 2016-02 and their subsequent guidance, and what it means for your school. We'll cover the key accounting aspects of this guidance and implications on the composite score ratio. We are sharing this guidance as part of our vision to be the thought leader, providing consulting and compliance solutions to institutions nationwide so schools can focus on changing their students' lives. Performing the majority of the presentation today will be Rob Baer and Tom Wilson. Rob is a director with significant client responsibility, and he also oversees our 401k plan audits. Tom is a senior manager and one of our technical experts, along with client responsibility. Both of them spend almost all of their time working with post-secondary institutions. Before we begin, we do have a few housekeeping items for you. Reminder that this information today is not legal or regulatory advice. Some of the commentary is our interpretation or best guidance, which may not apply in every situation. So as always, please consult your advisors and consultants to be certain to discuss the facts in detail with them. We do anticipate questions, so please know that we will be actively organizing them as they come through. If some questions can be wrapped into one, we will likely combine them. We will address as many questions as possible during and at the end of the presentation. In addition, we'll be recording the event today, and the recording file and presentation will be made available in the next few days to all who attend. We have a COVID resource page on our website that houses previous webinars and blog articles. We also have resources that cover the new 9010 regulation and a forthcoming article related to potential gainful employment changes. Stay tuned for numerous items over the summer due to all of the regulatory and financial reporting changes. We know with the negotiated rulemaking that this is a very busy summer, so we're here as a resource and to work with our institutions. With that, let's get into the presentation. What we're going to cover today is the first part is going to be kind of going over the lease standard, which is going to be done by Rob. He'll go through a brief overview, talk about how you measure leases, once you've measured them, how you account for them and report them on your financial statements, overview of modifications when changes are made to leases, the transition method that you will employ during this year when you adopt the lease standard for the first time, and then some policy election and practical expedients, which are basically simplifications that are allowed for private companies. Hopefully to make it easier for this whole process. Tom will then talk about the composite score ratio impact and the impact on other possible ratios as well. This guidance has been in the works for a long time, as the Financial Accounting Standards Board began the work on this standard in 2006 with a discussion paper beginning as far back as 1996. So think about that length of time. As I was kind of getting ready, Tom Brady had not won a Super Bowl at that point. The Pirates were still relatively competitive in baseball, and now anyone who follows baseball knows that's no longer true. Enron happened in 2001. The last space shuttle launched in 2011. And any intern that we've had over the last 2 years was likely not born or an infant. So that's how far back these standards go. The Pennsylvania Association of CPAs requested an additional delay during 21 to add another year of delay to this, and the FASB said no. They've had 20 or 30 years of work trying to get to this point, and they've delayed it a couple of times because of complexities and delayed it once because of COVID already, and they told the PICPA that's not going to happen. So this lease standard is going to come as of 12/31/22, and we need to be ready for it because as far as the standard setters feel, the talking's done and it's time to implement this and move on. So I'm going to be turning it over to Rob here, but we have a polling question just to get a sense of where people are with looking at the lease standard. So our first polling question is, have you begun reviewing leases in detail to compute the balance sheet impact? Just a very simple yes or no answer. Let's see, so we've got, all right, not too bad. So right now we're running about, I'd say low to mid 50s saying yes, and middle to high 40s saying no. So it's pretty close to a 50-50 split. So with 42 answers, 43, man, it's almost 50-50 now. So for those of you who haven't looked at it all, hopefully today will be informative. And with that, Rob, I will turn it over to you.
Thanks, Mike. Good afternoon, everyone. As Mike said, I think we can, yep. As Mike said, the effective date for December year ends is December 31st, 2022. For some of the June year ends, it'll be June 30th, 2023. And what it applies to is leases greater than 1 year for which underlying tangible assets exist. So that's what you'll be recognizing on the balance sheet. It doesn't apply to leases of intangible assets, assets under construction, and inventory. And there's some other things the FASB mentioned, which I wouldn't think apply to anyone on this call. So those are covered under some of the other FASB guidance. The types of leases for the lessee, short-term lease is defined as 12 months or less, but you also have to consider renewal options as part of the lease term. So the original lease term is 12 months or less. If you have a lease renewal, that could potentially kick it over to a long-term lease. And in order to elect this option, you're going to elect the accounting policy election to not record it on the balance sheet, and it's done by asset class. The operating leases are typically property leases, which most of you are familiar with. That's the real estate leases for the most part. Finance leases, the old capital leases, which main things we see are computers and copiers.
And Rob, stop me here for a second. Thinking through, jumping ahead a little bit, the operating and finance lease, Rob will walk through kind of the difference on the balance sheet and income statement, which isn't a huge bearing. But for the finance leases, the standard did not really define any of the bright line tests again. It seems to be the same test as the old capital lease standards, right? That we're running through. So if you think of it, what those 4 standards were, do you just want to expand upon that?
Yeah, that's true, Mike. So the 4 criteria that existed under the old lease standard still apply under the new lease standard. There is one new criteria, 5th criteria, and it's that if the asset is so specialized that there's no alternative use at the end of the lease term, then that could kick you over to a capital or finance lease as well. Yeah. So something new that they added.
And I think for, thinking through for, our institutions, leasing building space, copiers, maybe some equipment and trade programs, it's unlikely anything's going to be that specialized of a use that's not going to have any other purpose because someone else can come along.
Right. I agree.
Yeah. And so thinking through the old finance test, if the property transfers to the leasee, there's a bargain purchase, or if you use a certain percentage of the remaining life or pay for a percentage of the net present value. If you're beyond certain thresholds, then it would be a finance lease, which could very happen for equipment and copiers. But for a real estate lease, you'd really have to have an ultra long lease, especially for buildings and for institutions. I mean, their life is pretty long. There's not a lot of wear and tear on a building that's really an office space, or for institutions, especially without dormitories, right? Those buildings have long lives. So we'd think it'd be very unlikely unless for some reason a really lengthy lease was signed.
Yeah, I definitely agree with that comment. Related party leases. So they did change the criteria under the new lease standard compared to the old. So based on the new lease standard, it's based on legally enforceable terms and conditions, where compared to the old lease standard, it was based on the economic substance of the arrangement. So definitely different in how you look at the related party leases, which using the enforceable terms and conditions of lease is same as if it's a related party or not a related party.
Yeah, this is one of the areas, Rob and Tom too, if chime in, that as we're looking through the standard, it's going to be hard to say, well, there's just one size that fits every situation. One of the things the guidance talks about is even if there's not a lease agreement, if there's other legally enforceable conditions or terms, what we could be thinking of is is there a guarantee that the lessee has to make the mortgage payment on behalf of a related party landlord. So while no lease exists, there's now an enforceable obligation that could create having to put the lease on a balance sheet as well. Or if significant improvements are put into a project by the lessee on a month-to-month related party lease, well, now there's almost a penalty if you'd walk away because you've invested all this money in the property. That now may make you say, well, there's an implicit reason that this lease is going to be for a period of time. And that's where it's going to get very difficult to have just a bright line, black or white answer, and really have to look at the facts and circumstances for each client. But we think this is one of the things that will take a lot of work between now and then of the year as we discuss with clients in that situation, at least.
Yeah, I agree, Mike. And, it could be the case with the evergreen leases, those perpetual leases where there's no end date, right? That lease continues on until someone cancels it. And so what does that lease term result in? Like, where do you cut it off? So I do think some of the challenges will be the short-term and long-term classification potentially, and then ultimately coming up with what your actual lease term is. It's typically not defined in, related party agreement.
Yeah, so this could be an area that we could be asking additional questions in audit that maybe we hadn't gotten into before, but really understanding if there's any other relationships or contracts, explicit or implicit in between the related parties that, while it may not be a lease agreement, but that's creating a legally enforceable terms and conditions and or penalties if revocation of the lease were to occur, to try to figure out, do we have to record something on the balance sheet or can it stay off the balance sheet?
So continue on with the overview. The definition of a lease is a lease contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. And this is a two-step process. So step one is determining whether the customer has the right to control the use of the asset. And how do you determine that? Well, do they have substantially all of the economic benefits from the use of the asset? They're either using it, holding it, or subleasing it. And then also, they have the right to direct the use of the asset. How and what purpose? And then step two is determining the extent of the customer's control. So it's a two-part, two-step process in determining the lease.
And one of the things that, some of the guidance that we've seen through other CPEs was talking about, fiber optic lines or assets that are shared, and we don't think we see that much in our industry. So for example, if you lease a floor of a building, you've got the entire floor. Well, the building's shared, you're not sharing that floor with anyone else. And I know we've even talked to a few clients who've got large IT hosting contracts. And does that third party host company have dedicated servers to a specific institution? Because in that case, that service contract could be a lease because they're dedicating X servers to a certain institution. What it seems like is either the servers are owned directly by the institution, and so they're already paid for them as PP&E, or those servers are owned by the third party and they can move those servers around to any client they want at any time. So in essence, the institution is not in control of it. And same with a fiber optic line. You may be paying for a piece of the line, but the tech company has the right to move you anywhere on that line at any time. So there's no distinct asset. But as Rob talked, I think Rob and Tom would agree, if you have other types of contracts, it doesn't hurt just to take a quick look at them and be certain there's not an identifiable asset in there that would fall under the lease standard. While we think it's pretty unlikely from what the preliminary research we've done.
Yeah, that's a good point, Mike. I definitely think, I do not think there's significant risk to the industry, but yeah, if you do have these types of contracts, I think you definitely should be reviewing them in detail.
And items, you guys agree, things, if you have cafeteria contracts for employees, those are certainly excluded because employees do not fall under a tangible asset.
Correct. Okay, moving into the measurement of the lease contract. Required to bifurcate the lease and non-lease components of the contract. And you can choose not to. There's a practical expedient that says, hey, you can combine everything into one. However, by doing that, you're definitely going to be increasing your right to use asset and liability. So I think for those non-components, which is typically your insurance and property taxes, and your non-lease components, you'd want to, if possible, break those out. So when does the lease begin? So commencement, the date the lessor makes an underlying asset available for use to a lessee. Compared to, I think under the old standard, when you looked at the inception of the lease and the day when they generally signed the agreement. So I think this could be a little challenging, determining when the lessee has access and control. I think is going to drive and determine what that commencement date is.
Yeah, we were working on a project for a client recently who's looking to sign a lease here soon and move into the space late in 2022. And there's a 6-month period with which they don't have access to the building because they're going to be, the landlord's going to be doing the build out for the space. And so from our research, the commencement will begin, basically, we're going to say 12/1. However, if the institution would have access to that space in that 6 months, and if they are directing the leasehold improvements, then from what our research would say is that the commencement of the lease begins May 2022. So it's still the same cost, the same payments aren't changing over that lease term, but you've got to start it 6 months earlier, which means you're putting, in essence, the right to use asset and liability go on your balance sheet as of, in this case, it would have been May. And then you're now expensing over an additional 6 months. So you're not paying more, you're not paying higher rent, but you're extending that expense over 6 more months. So you're lowering the monthly expense, but you're including that on 6 months earlier. So you got to think about that when you're doing composite score projections. I think in their mind, they were going to have 1 month of rent, which in the case we're looking at is what they're going to have since they don't have control of the space. But potentially we had a risk that they were picking up 7 or 8 months of rent expense in the current year, depending on who is going to control during that build out period. So those are important factors we need to know as we start analyzing the leases, and as you're looking at them as well.
So for the lease term is the non-cancelable lease period plus any option periods if reasonably certain to exercise. And some of the factors that we need to consider when determining a lease term, and if you should include a renewal option, 1 or 2 renewal options, is the following factors. There's contract, the renewal termination options, asset. Do you have significant leasehold improvements where you've invested a significant amount of money in the improvements, which would lead to evidence it's more likely that you would renew or extend. Entity would be the financial impact of extending or terminating. Like, what's the impact on the entity's operations? And then market, what's the current market rental or purchase rates? I'd see probably number 1, the contract, and asset 2, maybe more relevant, more likely to have an impact, is my sense.
Yeah, Robin, I'd agree. As I thought through the market, and I would say our CFOs and controllers probably have a better idea than we do, since we're not working at the school, that because of the nature of institutions, that there's various locations and spaces you could use. Now, certainly there's reasons, Jenna, you want to locate in certain areas because of proximity to transportation lines or geographic reasons, but finding office space isn't necessarily it's not a specialized asset, right? So would you agree that there's various options out there for space if you're looking at a general geographic area?
Yeah, absolutely.
Anything else on kind of the renewals or termination options or leasehold improvements we think we're going to look at that could drive it?
Yeah, I think this is one where it's facts, circumstances, judgment. That we're going to have to look at this pretty closely to determine, if an entity should be including renewal period or not. Like, I don't think it's, just black and white. And I think it'll be a case by case, potentially client by client basis.
I think the leasehold improvements is a big one. The other one we thought about was the favorability of renewal options. I mean, if it's a really favorable lease, it might be hard pressed to say you're not going to extend that option unless there's some other market reasons, right? You think you're no longer in the right area that could drive that. But favorable lease terms could certainly go a long way to say, hey, we think you're getting close to renewing this. We think we should recognize it because the evidence shows you're probably going to stay.
Take a look at the lease payments, continue on with measurement. And as we've covered the last few slides and now this slide, these are all the data inputs that are going to go into the lease calculation, which we have an example, as Mike mentioned earlier, about an operating and finance lease we'll walk through. But the lease payments is the lease liability equals the present value of the lease payments. And what do the payments include? It's the non-cancelable lease term plus reasonably certain renewal periods. The variable payments based on index or rate, that's a change in the CPI that we've seen mainly, plus exercise of reasonably certain purchase option, plus termination payments, and then plus amounts probable for residual value guarantee applies to the lessee only. The discount rate, which is, again, another data input in the calculation in measuring the lease. So you're required to use the rate that's implicit in the lease if readily determinable. I don't think that's very likely and haven't seen that much at all. So if not going to use that, then you have to use the estimated incremental borrowing rate, the IBR. And I think that could get somewhat challenging. But it has to be the rate that a lessee would have to pay to borrow on a secured or collateralized basis over a similar term of the lease to pay the underlying lease payments. Now, if you don't want to look at either of those options, then there's an accounting policy election where you can elect to use the risk-free rate to measure all your lease liabilities. The downside to that is that interest rate is more than likely going to be lower than the implicit rate and the IBR. So the interest rate and the right to use asset and liability you're going to record are inversely related. So the lower the rate, the higher the right to use asset and liability that you're going to have to record. But just further add that the IBR, I think, could be challenging in coming up with that on your own. And I don't know if Mike, you want to expand on some of the things we were looking at.
Yeah, just a couple of comments. I hadn't thought of this before, but if the Fed keeps raising rates, it may help the risk-free rate as well. So we'll get some benefit out of that. The incremental borrowing rate, we want to be very clear that this is a rate that you cannot just make a guess at. I mean, I know there are some estimates in financial statements, whether goodwill is impaired and the allowance is an estimate that, as auditors, we can get a good handle of from our understanding of the industry. But the IBR is a very specific calculation. It's based on credit spread. It's based on payment structure, the effect of security or collateral. It's adjusted for the rate, the term of the lease, and then you have to add a risk-free rate to it. What they're saying is what would be that's the incremental borrowing rate for you to purchase this property on a secured basis. So basically, if you think about buying a building, what would that be? And so there is no way we can audit that number unless, in most cases, a third party has done that. If it's just an estimate that management provides to us, unless, let's say, you've got a very sophisticated treasury department with detailed calculations, we are not going to accept that in our audit. It's way too much risk as us for auditors. It's one of the things when our papers go through peer review, they look at what the key estimates are, and that would be something we just cannot do. And so we want to be clear that if you don't want to use the risk-free rate, and for good reason, it could have a bearing on the calculation, you need to engage a third-party company to compute the incremental borrowing rate. And we're going to keep reminding clients of this so we don't run into a situation that we're rejecting it in busy season of 2023 or saying we can't use this rate. But and we may have resources we can refer to you to do that, but it's definitely something we can't do it. First of all, as the auditor, and two, is we're not qualified to do it. It's not in our wheelhouse. But keep that in mind, and we can talk more about it offline. There's some good resources from the larger firms that really show what goes into it, but why we just can't pick a number out of the air and make an estimate on it. So Rob, real quick, before we go to slide 15, we have another polling question for everyone. which I am sharing that now. So the question is, do you plan to perform the lease computations in-house or outsource to a third party? And that could be lease company, it could be your auditors, it could be a consultant, and any form of third party. This one's running 50-50 as well.
Yeah.
There you go. We'll just give another second here. 55-45. So, all right. That one I thought would be more outsourced. So obviously, maybe some people have some good handle on it and think they could run it. So I'm kind of like maintaining depreciation. I guess if you only have a couple to do to get up to speed and go through it, it may not be that difficult of a task to do. So, okay, Rob, turn it back to you. Most answers are in.
Okay. So let's talk about the accounting now and the recognition of the right to use asset and liability. So in the initial measurement, and we'll walk through this example in the next slide or two, in the initial measurement, the right to use asset will equal the lease liability. Now, that's once you measure it. There are some things that can cause the right to use asset to change. The first item, if you have prepaid rent, that'll be an increase to the right to use asset. If you have lease incentives, TIAs, et cetera, that'll be subtracted from the right to use asset. And then indirect costs, incremental cost would have not incurred if the lease had not been obtained. That would be added to the right to use asset. And I think the big one that people were wondering is the deferred rent credit. You know, for those of you that have that deferred rent credit or these credits for TIAs and lease incentives sitting on your balance sheet at 12/31, they are going to go away and be adjusted against the right to use asset. They will reduce the right to use asset.
And Rob, if we think about it, institutions have basically recorded expense in excess of the cash payment. So you've taken expense over the years, and the FASB is basically saying, well, you can't just reverse that to equity when you adopt it, but it's going to reduce your right to use asset, which is ultimately your expense. So you're going to recognize, you're going to kind of amortize that over time, over the remaining period, similar to how you've recorded the expense. So we were hoping to be a one-time benefit, but it's not. But you do reverse the expense, so it will wash for you in theory over the term of the lease, just like it would have.
Correct. Okay, so let's walk through an example. This is an example for a lessee. Following assumptions. So the commencement date is 1/1/2022. Lease terms 5 years. Monthly payments are $10,000, $15,000, $20,000, $25,000, and $30,000. And if I did the math correctly, it's $1.2 million total cost of the lease, using a discount rate of 3%. So if we want to take a look at our amortization table, and this is based off of the software or accounting research tool that we use in-house to calculate the leases. So if you look at the items highlighted in yellow, doing the net present value of the 1.2 million is $1,099,120, and that's your initial recording of the right to use asset and liability. And we have the entries on the subsequent slide, which we can walk through as well. But then looking at the left, the $20,000, that's your straight line of the rent expense, rent or lease expense. And then you'll have your adjustment to the right to use asset for $17,277, and then the adjustment to the lease liability for the $27,23 for the interest piece.
And we didn't put a slide on this, but Rob, I think this is where the didn't have an example, but if you had an incremental borrowing rate, right? So maybe you could borrow and acquire that building at a 6 or 8% interest rate. Those numbers in yellow, are going to go down. So the liability is going to go down, and the right to use assets going to go down because the net present value is just going to be less, and that's the big difference you're going to see using the IBR.
Correct.
So here's the entries you referred to.
Yeah, here's the entries. Again, the items in yellow are the initial recording of the right to use asset and liability. Entry number 2 is recording the lease expense, and the lease expense will be $20,000 throughout the life of the lease term. The only thing will change will be the adjustment to the right to use asset and the adjustment to the right to use liability for the interest piece. And then lastly is the cash that you pay on the lease, and that's just based off of the lease agreement.
And we end here at the $1,081,000 and the $1,091,000 for your asset and liability. And If I go back, it ties into the numbers in gray. So after you set it up, the numbers do not run equally. I think the variance isn't that great though. You'll see over the time period. There's some separation on them.
Okay, so using the same facts and circumstances and assumptions, let's just assume this is a finance lease, same payment structure, lease term, discount rate. So when you record the right to use asset and liability, it's the same at initial measurement, right? So same asset, same liability. What's different is you're making the monthly entries, is your adjustment to the right to use asset. That's just a straight line amortization of the asset. And then also for your interest expense and the cash paid, that's just your payment on the principal. And I think, Mike, we page down to the next slide, we can kind of just walk through some of the entries. So again, the initial measurement is the same as an operating lease to record the interest expense. You do that on a monthly basis. Entry number 3 is the cash that you will pay, and you can combine entries 2 and 3. We kind of broke them out separately just to make it simple for walking through the example. And then lastly is the amortization expense over the life of the asset.
Good, Rob.
Sorry, I was gonna say what you will see comparing the finance lease to the operating is that the liability at the end of month 1 is the same. So the $1,091,843 is the same right to use liability under the operating lease.
And if we think about what's really happening, think of the finance lease as if you're making a purchase. And so you're going to have, in essence, it's treating them more like you bought a building. You're going to have depreciation and interest, which tends to have a little bit higher expense because of interest in the early years, and then lower expense in the later years. While the operating lease is going to flatline the decrease of the right to use asset. So it makes sense. The right to use asset in the finance is a little bit lower because you're taking a little more expense up front. So your P&L, let's say this is 5 years. Over the 5 years, we'll have the same expense, but it may not be exactly the same every year on the operating compared to the finance. But we think that's a fairly low variance from look at the numbers, and it's not going to be a big driver in a lot of the covenants and ultimate results. I think the biggest driver is going to be how big that asset and liability are at the beginning.
Yep. Yeah, and then this presentation is available, I think, for everyone to download. So if we walk through those entries kind of quickly, you'll be able to download the presentation and take a look at the entries and the amortization schedules after this presentation. Okay, so just looking at the financial statement presentation, operating versus finance. The balance sheet is going to be the same. You have the right to use asset under operating and finance. That's a long-term asset. And then you have your lease liability, of your current and long-term portion. Now, if you have both an operating lease and a finance lease, I think you have to distinguish that on the balance sheet. So you may have a line for operating and for finance. Or if you did combine them, you'd want to explain it in the footnotes. And then on the income statement side, under the operating lease, it's just the lease or rent expense, single line item. On the income statement, it's the interest expense and amortization expense for the finance lease. And then the cash flow presentation under the operating lease, the cash paid goes under operating. And then for the finance lease, cash paid on principal is financing, and cash paid for interest is under operating.
So Rob, do you want to expand a little bit? When we were preparing, you talked a little bit about the impact on EBITDA. Just thinking through this.
Yeah, absolutely. And I think we do have a slide later on, but I think the question was we wouldn't expect that the rent expense under an operating lease would be treated differently. So it wouldn't be an add back for the EBITDA calculation. But if you were to enter into some sales or purchase agreement, you may just want to specify in that agreement that actually is not factored in. Because you are amortizing an asset, but it is true rent expense.
Yeah, because you think about now, if you own an item and you've got interest in depreciation amortization, it's going to be an add back compared to a lease commitment where it's not. Well, now they're both on your balance sheet, but from an EBITDA calc, it's still going to currently say the same thing. If it's an operating lease, well, then the rent expense is not an add back. But if there's really a finance lease, it is. I'm curious to see what what that does in transactions as we move forward. Maybe nothing changes, but it will be curious to see if buyers and sellers start looking at this in a different light as well. I mean, theoretically, maybe it shouldn't. I mean, and the reality of the accounting rules shouldn't change necessarily the economics of a transaction. But it's things I think we certainly want to understand. You know.
Okay, so let's take a look at accounting for lease modification. So we know, after we have our initial measurement, there's going to be changes potentially to the lease. If you lease additional space, or if you're shortening or extending the lease term, that's going to have some modification or adjustment to your right to use asset and liability. So it's treated as a separate contract if it's an additional right, meaning additional space or square footage, and then not a separate contract if you're just increasing or decreasing the lease term, just modifying an existing right that you already had. So under the transition relief under ASU 2018-11, which I think we're probably all thankful for this, especially for those with comparative statements. What it basically says is you don't have to go back and recast the first year in a comparative financial statement. So you don't have to go back to 2021 if you're a December year end. You don't have to go back to 1/1, 21 through 12/31 and recast this. You can adopt it as if it's 1/1/22. So in that case, you would still have leases on the books under the old lease standard, ASC 840, and then 2022 would be under the new standard, and potentially have disclosures for both in your financial statements.
Yeah, I'd say Rob's had the pleasure of going through at least one client where the leases are, and we're not getting into any disclosures today, but I'd say they're fairly extensive and certainly will take some time to gather. I mean, they do ask for things like weighted average of the lease terms, and it will take work and certainly going to add time to drafting audited financial statements.
Yep, I agree. And then some of the practical expedients in transition. So they refer to these as the package of three. The first one, you don't have to reassess whether a contract is or contains a lease, i.e. embedded leases, service or outsourcing contracts. You don't have to reassess the lease classification, operating or finance. If it was operating prior to the adoption, it's operating now. If it was finance prior, it's finance now. And lastly, you don't have to reassess the initial direct costs, which I don't think we'll see or have seen much of that. But the key is you have to elect all three. They cannot be elected individually. And I think for the most part, most people on this call or clients would adopt this.
I would agree. I was going to follow up on that. And again, I can't say, I've only seen where people have paid significant broker fees only a handful of times over the years. It just, I think, at least the industry we're in, that doesn't seem to be a terribly common item. And external legal fees, some of these just don't tend to be that material. So we may not pick them up in the right to use asset because it overall won't affect the materiality of what it's going to be on the balance sheet anyways. So we're going to do our last polling question here before we move over to Tom. And the question is, do you anticipate the impact will materially affect the composite score ratio or other covenants? This one's running. This one's certainly running 2/3, 1/3, where people think it's going to certainly impact the composite score. And so, Rob, while people are going, you have one more slide. I apologize. You want to go through the last practical expedient, and then we'll turn it over to Tom.
Sure. So the last transition practical expedient is hindsight, which allows lessees to look back at other factors when determining lease terms, such as options to buy, terminate, extend a lease, or reassess to go forward. So based on information that you know now, you can look back and make that determination or consideration for recording the lease.
So Tom or Rob, either of you two have a thought, just as the question is, do you have a thought of how long it will take to go through, say, one lease? And again, leases are all different, so it's not like we can do one and say, well, the other 12 are going to be exactly the same, unless it really is maybe the same landlord with exact same terms. That could help a little bit. I have seen that occasionally. But do you have a thought of what it's going to take each lease?
Yeah,
time you read it and drop it in the model?
that's a good question. I think it definitely will vary, Mike. Like for me, the data inputs, like once you get those and drop it in the model, that's not very time consuming. It's analyzing, determining what those inputs should be, the lease term, the discount rate. But for some of the ones that I have done previously, a few hours, 3 to 5 hours potentially on average.
Yeah, and some of it could be the variable components, those non-lease components, whether they're fixed included or not. That to me is one of the areas that certainly will take time to understand. And if it's part of that lease amount, if not, how do we break it out if they're not going to follow the practical expedient?
Right.
Yeah, I would say in addition to taking the commencement date of the lease, making sure that's documented, because it's not necessarily going to be stated in the lease about when you're actually allowed access and be able to take control of the property for the most part when it's a real estate lease. So
yeah, good point on it. That's on the one we were working on. We had to kind of go back and forth with the school to determine that. So now that Rob's given the overview of the standard, this is kind of where the rubber hits the road. So what's the impact? So we're going to turn it over to Tom to show, how it rolls into the composite score and some other ratios as well.
Yeah, so for the composite score ratio, it may impact the primary reserve ratio. It may not. It may also or may not impact the equity ratio. That all is going to depend upon the classification of the leases. The department came out and, referring to leases, I'm sure you're familiar with the terms pre-implementation and post-implementation. So any lease entered into before December 15, 2018 is considered pre-implementation lease, and any lease entered into on or after that date is considered post-implementation lease. And I know that's a few years ago, but they came out with this and they wrote this prior to the COVID delay for the lease standard. So that includes amendments being made. So if you had a lease that was entered into before December 15, 2018, but then entered into an amendment since then, that most likely triggered and will now be considered a post-implementation lease as well. For the net income ratio portion of the composite score, for the most part, we're assuming that there's no or very minimal impact, as the new lease standard, it didn't significantly change the net income impact of leases, just a matter of putting them on the balance sheet. So even though there is a slight net income impact of it, we're, for the most part, assuming that it's going to be a very minimal impact or no impact at all when we're trying to run projections through the composite score ratio.
And just a refresher on the 12/15/2018, that was the date after which publicly traded companies had to put leases on their balance sheet. So that's the date the department just used as the evaluation of pre and post implementation. Why they didn't use the date you actually had to put it on your balance sheet, which would have been 12/31/22, but that's the date they used. So it is kind of an oddity from the fact it's a few years ago, and if things happened since then, by the time those rules came out, you couldn't really make a change. It was too late, because I think that date might have already been passed, unfortunately. But that's the date they're using for their pre and post.
So for the pre-implementation leases, for the primary reserve ratio, the adjusted equity portion of the calculation, it either will not change or will increase. So that will result in either a neutral or positive impact of the composite score, because the lease liability add back is not, in that situation, the lease liability add back is not limited to the right of use asset. There is an example here in a couple slides that you'll see how that flows. And for the equity ratio, kind of similar, the modified equity, that either does not increase or does not change or increases, which will have a neutral or positive impact as well. And it's similar to the same thing as above, that the lease liability add back is not limited to the right of use asset. And for the modified assets calculation portion, that does not change. So it will have a neutral add back, because either way, the right of use asset is either backed out or not included in the calculation. So for post-implementation leases, for the primary reserve ratio, the adjusted equity does not change, because the lease liability add back is limited to the right of use asset. Unlike the pre-implementation leases, you can only add back the liability that is not in excess of the right of use asset. For the equity ratio, modified equity does not change, which results in the neutral impact, is the same impact as above. and the modified assets increases, so it will have a negative impact as the right of use asset of post-implementation leases is not added back in that portion of the equity ratio.
And Tom, just thinking through the add back of the lease liability, I think from our understanding of the standard and looking at examples, the right to use asset is normally going to be the same or lower than the lease liability when the day you put them on the balance sheet, because the right to use assets, as Rob went through, starts with the lease liability, then it's subtracted or add to, for termination penalties or lease incentives. And so normally, if anything, that number is the same or lower. So you shouldn't be detrimented in the primary reserve ratio. I have not seen one where the asset's bigger than the liability. Not saying it won't ever happen, but I think that's going to be pretty darn rare.
Yeah, I think for that, the right to use asset, there are chances that it's going to be higher. But I think for the most part, what we've seen, especially if you have what Rob was referring to earlier, that deferred rent credit that's sitting on the balance sheet, since that is subtracting off the right of use asset, usually your right of use asset at the implementation of this on January 1st, 2022, the right to use asset will be less than the lease liability from the beginning of putting it on the balance sheet now. If you don't have a deferred rent credit, most likely your right to use asset is going to equal your lease liability for this initial adoption. So I know it's hard to see. On the left-hand side of the screen is the primary reserve ratio portion of the composite score calculation. That was the left-hand side of the screen. On the right-hand side is the equity ratio. So the first column is before implementing the new standard. The second column is post-implementate. If you considered, it was just an example of if the leases were considered all post-implementation. And then the third column is what if all the leases were considered pre-implementation leases. So again, it's not necessarily always going to be an all or nothing if you have multiple leases, but in this situation, I just wanted to show the difference between the two calculations. As you can see in the second column of the primary reserve ratio, you're subtracting out the right to use asset of, it's about 18 million, but then you're also adding it back to arrive at the total adjusted equity. That's why that portion of the calculation does not change. But for pre-implementation leases, so the ones that are before December 15, 2018, the add back of the lease liability is $19 million because that's what the liability balance is, as opposed to only subtracting out $18 million. So you actually get a slight bump in this ratio, bump up in this ratio for pre-implementation leases where the right to use asset is less than the lease liability. For the equity ratio, again, the first column is before the lease standard. As you can see, nothing changes in the modified equity for post-implementation, just because it's as if factored into the original decision. And then it's hard to see. The modified asset section increases because your total assets are going to increase by the right to use asset, but is then not being subtracted out as the pre-implementation right to use assets are in the third column. So in that situation, the second column, the post-implementation leases has a detriment to the calculation, as opposed to the pre-implementation leases actually has a slight benefit to the calculation because you're increasing the modified equity, but the total modified assets is remaining the same. And
again, there'll be, as you get the handout, it's a little harder to see, but you'll be able to take a look at it yourself and walk through the numbers.
I don't know, a couple of years ago, the department came out with quite like a Q&A. 3 of their questions are here. We thought it was beneficial to go over. So the first one of them was, can institutions opt out of the grandfathering of the pre and post implementation lease classifications? The answer to that is yes. However, if you do opt out, you cannot go back later and change. So in this first year, if you decide that you're just going to treat them all as post-implementation leases because you don't feel like tracking the difference between the pre and the post-implementation leases, that's fine. But 2 years from now, even 1 year from now, you can't go back and say, well, I'm going to have composite score issues. Can I reclassify this one lease technically was in existence prior to the December 15th date as a pre-implementation lease? The answer to that is no. Once it's adopted, you can't go back. How does a change of ownership impact the classification of pre and post-implementation leases? The department has said that all leases assumed in acquisitions are considered post-implementation leases, and their basis for that was, the leases are factored into the business decision of doing the acquisition and acquiring or assuming the liability. So that triggers the fact that it is now going to become a post-implementation lease. And then the one question was, how are the renewal options classified on existing pre-implementation leases? If the renewal option is not included in the original recording of the right to use asset and lease liability for pre-implementation leases, and you exercise the option, that is going to be treated as a post-implementation lease. So in other words, if you have a lease that's a pre-implementation and it has 3 5-year renewal options, for composite score purposes, it would most likely be beneficial not necessarily beneficial. Assuming you're going to exercise all 3 of those renewal options, would at least always consider those renewal options as pre-implementation leases instead of just using the first of the 5 years, and then upon the second year you're going to extend it up, and then that triggers it as being a post-implementation lease for the composite score calculation.
Yeah, I think on these 2 points, the one is the change of ownership, and that would be a change in ownership after 12/15/18.
Yes.
Because remember, this was part of the bar defense to repayment regulations that came out. And so if you have change of ownership before that date and you have leases signed before 12/15/18, you're okay. They're still pre-implementation, assuming no other changes have occurred. But if that sale happened after 12/15/18, department said that's a new business decision, and so they become tainted. The third option, I think, is a huge planning option. I mean, if you're in a lease and you think you're going to stay, and you're at year 3 of the first 5-year option, you got 5 more year options, and you think, yeah, I'm going to stay, and that lease was signed before 12/15/18, as Tom said, you can say, I'm going to put them all on my balance sheet now and lock it in as pre-implementation, but you've got to do it in this year. If you don't do it in this year, you can't do it in future years. And if you don't put all those options on your balance sheet at this time, when you exercise in the future, it becomes post-implementation. But if you've been in the space for 10, 20 years and you think you're going to stay, this is the case. Putting a bigger number on your balance sheet is better because you can lock it in as pre-implementation, assuming it doesn't affect any other covenants. I think the composite score is going to be the biggest covenant you have to comply with, but this could be a huge planning opportunity to lock in leases. And even if you do have to make a change, all right, maybe it's 5-7 years down the road, but you still get the benefit of treating this pre-implementation up until that point in time. So something we're definitely going to be looking closely at as we work through this with clients.
So some planning thoughts for the new lease standard related to the composite score: shorter lease extensions, 3 to 5 years instead of 10-year extension options, or things is one thing to consider. Have the landlord pay for the build-out improvements that will typically increase the right to use asset and lease liability. And it's better than a landlord tenant improvement allowance, as that increases the PP&E without any long-term debt add back. And another item to be is to investigate the implicit borrowing rate, which yields a lower right to use asset than the discount rate. Insurance, real estate taxes, and other CAM charges and separate from the lease payments. It's going back to bifurcating if it's included in the total as well, whether that process is worth going through, and capture upfront payments for any incentives. You also have to keep in mind what the lease standard will have on other ratios. Some of the other ratios that we just put down here, it's not an all-inclusive list, it's just a leverage ratio of a debt to equity, which would increase, a current ratio, current assets and current liabilities, which would decrease. A result of having to recognize the current portion of the lease liability, where the right to use asset is all non-current. And then also any EBITDA calculations for finance leases, most likely no change. In operating leases, it depends on how the lease expense is treated and recorded.
And I haven't had discussions with clients in so much as these other key metrics or ratios. They tend to monitor them internally, or if they've not met them, the landlord's been pretty, as long as they're not in default and they're making payments. I can't think of someone who hasn't gotten a waiver for passing a debt covenant in quite a long time. I'd say they were in severe financial distress and were probably failing the composite score anyways. So normally it's not as big a risk for people, and so it's not something that comes across our desk as often.
And I would assume for clients that have, or institutions that have debt and with debt covenants, obviously banks are aware of the accounting change and the lease changes and stuff like that. So I'm assuming, the banks will be working with their customers to try to figure out ways around or amend covenants if the lease standard is going to have an impact on some of the covenants that were put in place prior to contemplating the impact of the new lease standard.
Or sometimes maybe they're just going to throw it out and continue the same as well. Tom?
This is Domi. So to summarize for the leases, was best practice inventory of leases. That's, I think one of the things that you might think sounds easy, but it may not necessarily be as easy, because you want to make sure you're counting all like smaller leases and even the copier leases and stuff like that. You might have a few copier leases that are not materially individually, but added up may result in a material dollar amount for some of the other small leases. Obviously, if you haven't already started, I would start now as soon as possible. The more leases you have, the longer it's going to take. So, starting to at least have a idea if you need to plan for year-end composite score or other ratios would give you as much time as possible to plan for it, and run projections before signing or renewals or new extensions for any current leases you're thinking about entering into. I think you don't want to get yourself in a situation where you've signed a lease and after you recorded it, then you realize that it had a negative impact on something that could have been avoided had the composite score or the ratio been factored into the decision before entering into a lease, which is the last bullet point, is to make sure you're ensuring that the composite score ratio and other covenants are not going to be significantly negatively impacted as a result of entering into new leases or extensions.
Rob, any final comments just here? I'd agree with all those items.
Yeah, same, Mike. I agree.
I'd like to thank Rob and Tom for their knowledge and providing an overview of the lease standard. I know we hit a lot today along with the composite score, but we want to be certain it's on everyone's radar. Either you've heard it and it's a good refresher, or you haven't heard it and it's time to start thinking about it. We're going to see if we have any questions coming through. We'll try to cover as many as possible. If we're not able to, we'll keep your question and try to reach out to you individually, or if it's just too detailed of a question to do in the webinar here, we'll follow up outside of it. So I'm going to see, so I'm looking for one of our moderators here. Looks like we don't really have any questions.
There's one question, the one question related to the equipment lease with a related party on a month-to-month. It says, what about an equipment lease with a related party month-to-month with the school having the ability to cancel?
So, what I would say on some of the evergreen leases, if they really were month-to-month and they renew automatically, is the concern that that's what they call evergreen now. That lease just continues on. But, having the cancellation notice in there, I have to go back and look at the guidance. May allow you not to have to record it, because if you can get out within a certain period of time frame. And I think it also depends if you have to replace that asset, how easy or how hard is it going to be? Now, if it's a piece of equipment like a copier or an item that you can replace pretty easily, I think that helps not having to record it. If it's a barrier that it's going to be hard to replace that asset or take time, I think that's then it's more likely that that lease is going to go on longer. So I think those are just an item we'd have to look at in detail, but having the cancellation in there could help. The other question we got, and didn't think of this in the presentation, is when going through Rob on the right to use asset that's long-term, but the lease liability has a current portion, correct? So you just want to expand upon that?
Yeah, the lease liability for operating or finance has a current and long-term portion. That's correct.
Yeah, and so if you think about Department of Ed or other lenders, if any type of lender or regulatory body is looking for a current ratio, current assets to current liabilities, you are going to have a current portion of the lease liability, which will be detrimental because the right to use asset is all long-term. Similar to buying a building, right? It's PP&E is not current, but you have a current portion of the mortgage. This will be a piece that impacts the asset test on acquisitions as well. You're going to drive up the current liabilities, and there's no offsetting piece that's in cash or accounts receivable. And we'll see how borrowers and sellers decide if they want to argue over that or if they accept that's just the new norm, and that's what the calculation is. But those are pieces that we're starting to work through in transactions here after the standard is implemented by everyone. So another question is, can we use a discount rate, can we use discount rate, the mortgage rate of the lessor used to finance the property leased? So Rob, I think that goes back to the rate that's implicit in the rate. And the question is, will the lessor actually tell you, right?
Yeah, exactly. I mean, if you're going to know that, I mean, I would think you could, but I mean, if they're explicitly saying, hey, this is the interest rate or discount rate.
From some of the guys, go ahead, Tom.
I was going to say, I mean, I would say potentially not, because what their interest rate is, it was not necessarily going to be your interest rate based on, credit risk and credit history or strength or health of the entity as an overall entity. It might be something close to it. It could be something used as I think a touch point to arrive at the interest rate, but I would lean away from saying that another entity's rate on the property is what my rate would be. Doesn't mean it can't be used, like I said, doesn't mean it can't be used as a basis in determining that rate though.
Yeah, Tom, I think that's right. The lessor, from what we've read, the lessor is unlikely to lots of times to tell you what the implicit rate in there, because that's obviously part of their profit. They may not want to disclose that to you. And the rate they used would differ for the school because their borrowing rate and security and financial is different. So I think their rate specifically could not be. It would have to be the rate within that they're giving you if they're willing to disclose that.
Yeah, and I agree with that. I think I misunderstood the question, so I definitely agree with what Tom said.
Yeah. So another question, what if an amendment to extend a lease was made prior to recording a right to use asset, but after 12/15/2018? Just make sure I follow.
So I'm
take a stab.
Assuming what there's like, if the I think what this is getting at, no, it just jumped on my screen, so I got to reread it. So any amendment that occurred after December 15th, 2018 or extension, I think would be treated as post-implementation.
And so I think in this case, if you sign that amendment before 12/15/18, but it didn't take effect to 3 or 4 years down the road, I think you're okay, because the modification was made before 12/15. I mean, maybe for some reason you decided to extend the lease and sign a renewal option early, saying, we know we're going to stay, we're going to put a bunch of money in. You did that before 12/15/18, even though that period didn't kick into after 12/15/18. I think that's okay because the trigger point happened before ED's pre and post date. But if you signed it after 12/15/18, it certainly would not qualify. So I think that's my best answer without having kind of all the facts and circumstances.
I think that would be right in the case of an amendment. If it was an extension being exercised, I think that's what the one expedient was referring to, that you can refer to stuff after the fact. So if the original lease was beforehand, but that had 3 5-year extensions that occurred, that you were evaluating the original lease that entered into before 12/15/2018, you could look at the facts and circumstances after the point on whether or not extensions would be exercised. So if one extension was already exercised after 12/15, I feel like that still might be pre-implementation lease, because it's just an exercising of the extension option of the original lease that was dated before December 18th. But any amendment, I think, would be post.
Yeah, so let's say you have a 5-year lease beginning January 1st, 18 with a 5-year option, right? And so that first 5 years is a pre-implementation. But if you say, you know what, I'm going to stay all 10, I'm going to put on my balance sheet now. You lock in that option period, even though it's in the future, because the lease started prior to 12/15/18, and you've decided to put those options on your balance sheet here at this 1-year opportunity. So when you do exercise that option in the future, that's what the ED definitely says, and you still locked it in as pre-implementation. So that's why it may be advantageous for those pre-implementation leases to consider how long you're really going to stay and what the option periods are on them. So I'm sorry. So I'm looking to see if okay, I don't see any other questions have come through. Let's see if any other ones pop up for us. So as you know, there is a handout. The handout should be available for everyone to download after the presentation. Certainly, the information of contact for Tom and Rob and I was on one of the first couple slides. Feel free to reach out to us with any questions. We're certainly working with both clients and non-clients to help people adopt the standard and to answer questions. So I'm not seeing any other questions at this point in time. Guys, do you see anything else coming through?
I
Do not.
Okay, so at this point, I think we'll sign off. We thank everyone for their time today. As I mentioned, we're already helping people, so if you need assistance, we are here. I'd advise you to work on this before end of the year, even if you're not using us. Don't save it for your auditors to do during the audit next year. Find out the impact before the year's over. Plan for it appropriately, especially if your composite score is close to that 1.5. And watch for future thought leadership we're going to be doing this summer. There's a lot going on with the negotiated rulemaking, 90/10s change. We know gainful employment's coming, so we're going to continue to put out guidance and help institutions adopt it and understand it before it becomes effective. So stay safe and take care, and thanks for attending today.